Okay, hey, good morning, guys, or afternoon now. We're going to get started here in a minute. So we'll let as many trickle in as possible, and then we'll get started here. Uh, Pretty sure that you guys can hear me since I have that music on. So, and yes, this is being recorded. So, okay. All right. So this is the SPX 7DTE workshop. So hope you're in the right place. We are having, excuse me, we are having another workshop on Thursday for futures, micro futures, and I'll give you the link to that one before the end of the session. So with that, let's get started here on the 7DTE workshop. All right. So what can you expect today? I'm going to show you how you can make consistent returns, and I'm speaking really consistent returns monthly based on margin capital risk using high probability trades such as SPX 7 DTE without taking large losses and make those returns month over month. And I will explain every detail to you on how to do this, okay? So the thing that you're going to learn, or what you're going to be learning, is how to select the right strike prices, number one. Number two, how to enter and exit your trades, and give you the criteria for that, and how to prevent large losses by managing threatened trades, and how to know when not to trade, and then how to trade consistently profitable. And that's the goal, right? That is really the goal for every trader. Okay, I want you to stay with me till the end. I've got a special bonus for you guys. It will, if you follow this program, and there's variations to it, this will change your trading life for good. I really, really believe that. It's done it for me, and it's done it for hundreds of people that I've worked with as well. Okay, so and I'm going to give you basically everything that I know about trading this strategy. So you're going to get a lot of info today. Okay. So the best thing to do is just make sure that you're focused today and you have all your distractions turned off. There is going to be a replay, and you're gonna get that, I believe, tomorrow. Okay. So take notes. And the other thing I'm going to ask you to do is to wait till the end to ask your questions. And we want to do that just because I want to get you through most of the material, and a lot of the questions are going to be answered in the material. But obviously, we all have questions, and can you hear me okay? Can everybody hear me okay? Just want to make sure. Okay. All right. And so, great. Okay, good. So don't worry about if you miss something. You'll have the replay and you'll have it for life, and so you can go back to it at any time. All right. So we're not hiding anything from you. Okay. So I wrote up 3 reasons why you may be here, number 1, you're interested in learning new strategies that'll take your trading performance to the next level so you can finally leave that 9-to-5 career behind. That's number 1. Number 2 reason you're here is you've read about others making money trading, and you can do it too, but you're just not seeing the account grow fast enough based on your goals, right? And number 3, you've tried different trading strategies that you thought, okay, this is it, only to discover that it's not getting you to that place of consistent trading results. Sometimes you think you're doing good. Oh, okay, my trades. And then you look at your account value and it's kind of stuck, right? Man, that's happened to me. So which one of these can you attest to, or can you relate to the most? 1, 2, or 3? Any combination, 1 or 2 or 3. If you can let me know in the chat so I know that you're awake there. 1, okay, great. 2, 3, all 3, yep. Okay, 2 and 3, perfect. Okay, perfect. Yep. So these are yeah, it's pretty common. I'm glad I put this out there. So um, uh, we'll come back to this a little bit, but first I want to just let you know a little bit about me. I live in Puerto Rico. That's my wife on the left hand side there, and me, and my 5 kids in the middle there. That was the my oldest son's wedding, and older picture there when I was doing my MBA. It's my parents, and just a regular guy. I live in Puerto Rico because my wife is from here, and now that all my kids are away, we decided to move out here, and it's a beautiful place. And it's great for business if you want to reduce your taxes too. Just a little plug there. All right, so the first thing I'm going to start out with is trader mindset. Okay, and this is really, really important as a trader. So imagine what it would feel like if most of your trades were winners month after month, and it would be confirmed by watching the size of your account grow, right? I mean, that's really the goal. You want to see your account grow and able to use that money that you make in trading, okay? Becoming the trader that no longer takes large losses, but consistently trades according to a proven trade plan that is profitable over time, allowing you to grow your account month over month, right? So that's really, really important not to take large losses. And I always say trade small and trade often, right? Because trading small allows you to keep your emotions in check, and often allows you to practice, which is what you need to do as a trader and grow experience. Okay, so supposedly, the more you trade, the better you get, and that's really the goal. Okay, and I'll walk you through that process and how to do that. Okay, so let's talk about first what is a credit spread, because some of you here might not even know what the heck a credit spread is. So a spread is made up of a combination of different types of options. All right, that's all it is. They're different types of options, and there's gazillions ways to create these, right? But my laser focus is completely on credit spreads and on SPX credit spreads, because you can trade other indexes, but I've chosen to use just SPX because it's really the most liquid index out there. All right, so a credit spread is a combination of 2 puts or 2 calls where the put or call that is sold is more expensive than the put or call that is bought. That's how you receive a credit. That's why it's called a credit spread, because when you actually put on this trade, you're receiving a credit from the options that you're putting on. Okay, so right off the bat, you're at a profit. Okay, the goal here is to keep that profit when you have to buy it back. All right, so this is basically the makeup of a credit spread. Okay, the 10 is the number of contracts. Vertical is really the type of spread it is. It's called a vertical. Okay, SPX, you think of 500, right? Well, it's 100. In this case, the 100 means that it's 100 shares per contract. All right, and that's why you see a lot of options with a 100 on there. Okay, these particular types of options are weeklies. They come out on Monday, Wednesday, and Friday most of the time. Also at the end of the quarter and the end of the month. All right, and they're called weeklies. And this is actually the expiration date. Okay, long time ago. But it's the expiration date, and then the 30/10 is the option that you sell, and the 35 is the option that you buy, creating a put credit spread. And another term is a bull credit spread. All right. And so in this case, what you did here, you had 10 contracts. You multiply that by 45 cents times 100, and that credit is $450. So that's what you receive when you put on this particular trade. All right. So again, you're selling the 30/10 put and buying the 35/05 put. Okay, in that vertical spread. If you were to just sell the 30/10 put, it would cost you hundreds of thousands of dollars. on the SPX in order to put on that trade. That would be a naked put. And you don't want to do that. You want to create a spread. And the trade is considered to be a high probability trade, right? But there's a catch to this, right? And I'm gonna tell you the ins and outs of this thing. Even though it's a very, very high probability trade, you must know how to manage it, because the risk reward in this trade is not good. Okay, and that's what you give up by having a very, very high probability trade. So the risk reward on this thing is, in this case, because we're trading 10 contracts 5 wide. Okay, this is called a 5 wide because this strike is 5 points away from this strike. Okay, and that's why it's called a 5 wide. And so you multiply that 5 times 10, and that's your risk. That's basically your risk on this trade. And because we sold it at $450 or 45 cents, we received that credit. This is basically the most that you'll make on this trade, right? And so the goal here is when you want to buy it back, you want to buy it back at the lowest premium possible, even zero if it expires. Okay, and then you get to keep that credit and you move on to the next trade. Okay, that's kind of how it works. But just remember, in this particular trade, your max loss is $5,000. Okay, so keep that in mind, understanding that you could lose $5,000 in this single trade if you just let it go and let it do its own thing without management. So proper management of this trade is essential. All right, so let's talk about options decay, the rate of decay. And this is one of the profitability factors and probably the strongest one for trading these options. Okay, so this is what happens to the life of an option from, let's say, 68 days to 33 days. From that point, it decays at 34. Basically, it decays by 34%. So if the decay, basically, if you put on that option, it'll lose 34% of its value during that period of time, during those 68 to 33 days. From 33 days to 5 days, and you can see that the rate of decay is increasing, right, as we click closer to expiration, and that's what happens. So from 33 to 5 days, it's 57% of its value. And at the end, 5 days to expiration, it's 100% of its value. So just to give you guys an understanding, I put on a credit spread yesterday, okay? And I put it on for 70 cents yesterday. And I'm going to tell you what the price is right now. So the price right now is 35 cents. So what happened? It already lost 50% of its value in 1 day, right? So that's the beauty of this trade. Now, if the market would have gone down, right, it would have increased in value, that premium that I put on. But since the volatility worked in my favor, and we're going to talk about volatility. Decay 1 day, not much, but in 1 day it actually decayed, all right? And the market was in my favor as well because it moved up. All those things accounted for that loss in value of that option, all right? Actually lost 50% of the option already. So based on my trade plan, because I get out of these trades when I get 50% to 80% of the credit, basically I can close this trade now and call it a winning trade. That's how easy it is, all right? Basically, that's how easy it is. And I do this over and over and over and over again. And I'll show you exactly, these examples in a minute. Okay, so let's talk about the 3 profitability factors here. Okay, and I call them profitability factors because this is what creates the profit in these trades. So implied volatility is number 1. So you want to, and here's the ideal setup, right? The ideal setup is a market with the volatility moving lower while in a trade. Okay, so you want to put it on when it's high, right? And yesterday we pretty much nailed it to be the highest in the day, all right? The highest volatility went up to 20, right? And then placing the trade when volatility is high and then decreases, will significantly reduce the initial premium collected. That's exactly the example I just gave you today, right? In this real trade that I put on. So the second is theta. Theta is the rate of decay, the rate of decline in the value of the option due to the passage of time. Excuse me a second. And this is this is the biggest factor, one of the biggest factors for 7DTE, because you saw that graph, right, where in 5 days it loses 100% of its value. And so I honed in on this, right, and said, okay, let's do 7 to give me time just in case we need to adjust this trade, but use that 5 to 0 DTE time frame so that we get the biggest bang for the buck. And man, has that worked big time. Okay, the third profitability factor is market direction. So in the example that I had today, all 3 were in my favor, and that's why we had that significant reduction in the premium. So a market trending away from your position will cause the premium price to drop. If you enter the trade and the market moves against you in the direction of the credit spread, you will see the premium price increase significantly sometimes as well. But as long as it stays within the acceptable range, it will remain profitable. All right. So I always look at the range of that trade, and that particular trade. So the S&P right now is at pretty much 4,006, and the strike price that I put on, and we'll talk about that, was 42.7, 42.60. Right. So when I put on this trade, I was over 100 points away from the market, and so technically it doesn't go unprofitable. It goes unprofitable once it breaches, but you never want to get it that close. Okay. But I have that huge amount of range in the market to allow it to do whatever it wants to do, and technically, it rarely breaches that far away in such a short period of time. And that's why it's a high probability trade. All right. Okay, so let's go on. Let's talk about real important stuff here before we get into the technicals of the trade, risk management, and the daily routines that I follow. Okay. So I always trade with a plan, and continuously updating that plan based on environment, the way I trade, the market conditions, the economy, etc. Okay. Number 2, determine max loss and risk reward before entering the trade. So we talked a lot about that. Okay. And I made it very, very clear that it's a dangerous trade if you don't manage it correctly. Okay. Trade no more than 20% credit margin of your trading capital. And you want to leave room for drawdowns, because a lot of times if the trade goes against you, it will draw down your account. Okay. Which means you'll see red at times for that. But if you stick to your trade plan, right, and you're disciplined on there, you will not have a problem. Right? Do not allow more than 2% loss based on trade capital. Okay, so for example, if you have a $10,000 account, right, that's capitalized at $10,000, your loss should be no greater than $200. Okay. And for highly trending market, position trades to follow the trend. And so this is a little tricky because, like yesterday, the market was moving against me, but I knew within that range, it was going to exhaust that move down and move back up. Okay. And that's basically what it did today. And so, but sometimes the market doesn't stop. Especially going up, right? The market moves up most of the time. And so most of the time you're going to want to put on bull spreads, not bear spreads. Lately, I've been putting on both just because of the conditions of the market. It's basically it's in a consolidation phase right now. Okay. And, we use certain technical indicators that show us that, and get prepared for those types of events. All right. Never hold a short-term credit spread overnight. And so when I say short-term, I say 1 day. And even if it's 2 days, I may let it go overnight one more. It depends on how far it is from the market. But generally, if it gets that close, then I'll just roll it out a week and roll it away from the market so that it doesn't, so it's no longer threatened. Okay, and that's basically how we manage trade, and I'll give you the specific parameters on that shortly here. Okay. Size your trade so your emotions are not part of the decision-making process. And again, trade small, trade often. And so I have a capital, structure that I use for the amount of contracts that I use. And I should have a slide for that, but I don't. But in any case, just remember this, right? When a $10,000 account, I trade one contract 10 wide for a monthly trade. I trade 3 7 DTE trades, right? Spread out amongst 3 different expirations. So that's 3 contracts spread across 3 different expirations, and then 0 DTE, 1 contract for that day trade. All right. So that's what I use for my trades, which brings me to 50%. So I'm using 50% of my capital at one time at any given time. And that allows me for drawdowns or anything else, right? So I don't go beyond 50% of my account. I used to go on beyond 50% account, and it got me into a lot of trouble, and your emotions play into it, and you lose money. And that's what's happened to me in the past. All right. So I stick to my rules now. Pre-market routine, review areas of support and resistance. Support and resistance, well, I have a slide on that, and then we'll show you how powerful that is. And that's really the number one indicator that I use. Okay, and these are used with Fibonacci retracement and extensions. I review the U.S. dollar because the S&P 500 is made up of multinational companies, and you want to you want to make sure that the dollar is not moving aggressively higher at one time, because that does affect the market. It'll typically go down when that happens, or even when the market when the dollar is moving down quickly, that causes problems as well, because companies have forecasts and the dollar can upset that to a certain extent. I review the 10-year Treasury because that gives you that gives you an understanding of what traders are trading based on the economy, the economic factors around the market. Okay, so a Treasury that's going up, 10-year Treasury notes rates that are going up, it competes for dollars from the market, and that's why the Fed is buying all these bonds basically to keep the rates low, so that we not put money into treasuries, but put money in the stock market. Okay, so that's how they keep the lid here on the market not going down. I review ES futures. ES is basically the S&P 500 futures, and I review that for trending direction. Understanding the trend of overnight trading is important when looking at especially short-term trades. The VIX, the VIX, is a symbol for the volatility index for the S&P 500. Every stock, every index has a volatility index associated with it, and the VIX is for the S&P 500, and that's the one that I watch, okay, and keep an eye on. And then I determine my credit spread positions, and I save them into my my phone or my monitor, or my broker, my account, to make sure that I'm ready to put on a trade when I want to put on that trade, right? When those conditions come into play, then I'm ready to put it on and not scrambling for which strikes I'm going to put on or what positions I'm going to put on. Okay, post-market routine. Determine if rules were broken and why. Really important, because you always want to stick to your trade plan. Determine if risks were within the acceptable levels, especially for wins, because if you have a winning trade, and you think, okay, worked this time, it'll probably work the next time. What happens is complacency comes in, and then boom, you get a hit, and that's not any fun. Okay, so always stick with your risks. Determine if losses were within acceptable ranges. Again, you don't want to take too big of a loss or too small of a loss, because then it messes up your risk reward and your profit over time. Determine if tweaks or adjustments in your trading plan is necessary. Again, you want to constantly be monitoring that to make sure that things are working as planned. Okay. Recently, I moved the time that I adjust the trade more conservative, because I was finding out that it was costing me a lot more to make those changes. So I moved it, moved the range higher, so that it wouldn't cost me that much when I had to make an adjustment, for a threatened trade. Update your trading journal, and especially if you're starting out, you want to keep a trading journal and understand what you're doing right and what you're doing wrong, and that's the way that you go back to those parameters and see what you're doing, see what you're changing, and always want to be in a continual improvement process role there, right, with your trading. All right, so let's talk about the specific strategy for 7DTE here. And let's talk about entry, exit guidelines here. So enter with small positions using multiple expirations. So I mentioned already the kind of rule of thumb that I use, right? And so I'll enter, right now I'm entering 6 to 7 positions on my spreads, and that's what I use based on my capital. Okay. So during market rallies, you want to put this on when volatility is higher, right? So when the market's rallying, it's really not a great time to put it on unless you think that the VIX is going to go lower from where it is, right? When you put it on, if you have a strong rally and the market continues moving up, yeah, it's okay, but always be cognizant what happens when the market turns, especially going down, volatility goes up, and boom, your premium prices go up as well. And so that's not good if you're in a position already. All right, so I use a delta. Delta is one of the Greeks. Okay, theta is another one. So I use a delta of 10 to 12 for the bull spread, and 7 to 10, and even 6 to, basically 6 to 7 is what I use for bear spreads, right? So that, and the reason for that is because the distance from the market for a bull spread is much further than it is for a bear spread. And that's just the way it is. So premium prices are lower for calls than they are for puts. And the reason for that is because the market, when it goes down aggressively, and it goes down faster than when the market's moving up. Moving up, it's just kind of ticking away and kind of marching up slowly, and that's how it works. Okay. Take profit. I take 50 to 80% of credit received, as I mentioned a few minutes ago, and usually close them out for 80%. Pretty consistently close it out for around 80%. So the ones that I close out at less than that is usually call spreads, because I just don't want a ripping rally to mess up my positions. All right. So if a position's already been rolled or adjusted, you want to take your profit target earlier, just because when you do roll a position, you don't usually use 10 or 12 delta. It's usually around 20 delta that you go for, because you don't want it to cost so much. But remember that, when you're managing a threatened trade, the market has already moved down against you, right? So moving it a little bit further away is the right thing to do. But making sure that you're able to do it again if the market continues going against you. Okay. All right, adjustment. You initiate the roll. This is when volatility is lower than 15%. I'm sorry, lower than 15. And you want to use 40 to 50 when the position is above 15. All right. So when it's around 18 to 20 like it is now, I'll usually roll a position when it's 50 points away from being threatened. Okay. Or for being breached, I should say. There's no stop losses on these, other than if you just don't want to deal with the especially in a call spread, you don't want to deal with the rolling of it. I'll take a small loss on these from every so often. Okay. But it's not a real, my plan for managing these trades is not a stop loss. It is an adjustment in the trade. So I'm going to walk you through a real trade adjustment. And this was a while back. Okay. But it still holds true. And I still use these from time to time. But for the past year, my trading has really improved, and I don't do a lot of adjustments anymore. But I know how to do them, and I know when to do them when the time comes. All right. Okay. And another reason for that, that it doesn't happen that much is because I'm really more in tune with the market and the pricing and everything else. It's just the experience that I have. After trading these, now for over 2 years, 70 TE over 2 years, monthly is, a lot longer than that. But in any case, I seldom put on call spreads, okay, because the market generally is going up most of the time. Alrighty, so let's talk about this trade. And this is when I was trading 5 wides, and I was actually testing the strategy, for a while. I tested it for 3 months in the market before I put it out there. So I put on a 29.45, 29.40 put spread for 45 cents. That's a bull spread. And then the call spread was this one here, 35, 30, 35, 30, 40 call spread at 40. So you can see that the premium is a little bit lower just because I was using a lower delta, okay, on this, right? And so what happened the next day, actually, the market moved against me. And so I decided to roll it just because it had breached the 20-point limit. And so when I put on, what I did was I rolled this trade up, to basically 20 points away. And it cost me 35 cents, right? And you hear that a lot of people, you shouldn't roll a trade unless you're going to get a credit. And, that's not correct. The goal of adjusting a trade is for risk management, de-risking the position, not for making a profit. Okay. So keep that in mind when you do that. On the other hand, on this one here, so I rolled this one, and then since this one was well out of the range, I was able to roll this one a little bit less. I rolled this one for 10 points instead of 20, and got a 30% credit on this, 30-cent credit on this. So all in all, basically, I spent 5 cents to get the trade out of being threatened. So So all in all, the trade was still very profitable. Okay. So at the end, basically I bought it to close at 10 cents on the bear spread and 10 cents on the bull spread, leaving me with, 60 cents. So basically I collected 85 cents, when I put on the trade. I paid 5 cents to roll it, and then I took a 60-cent profit on the entire trade. Okay, and that's the way I look at it. I don't look at it just by leg. I look at it as a composite trade that I'm doing, and keeping it together with the rolls or the adjustments, so that you come out ahead at the end. Right? Okay. All right, so let's talk about, you know, I'm going to walk you through these trades that I did in April, okay, of 2020. All right, I know it's a long time ago, but this is a great example of trading within a very, very, very choppy market that we were having at that time. All right. So the first trade I put on was 2025 2520 2515 put spread, and then after that I put on the call spread for the same expiration, and I closed the first position, right? So it was basically 2 days after I put on that position that I closed it. Next, I put on a call spread. It was 20 April as well, right? And then I closed that trade basically a day later because we had a gap up in the market and closed it for 5 cents. Right. So now I'm 45 cents or 90 cents for the month. Right. So I put on a 20 April, 26.25, 26.20 put spread, and then closed it for 15 cents in 2 days later. That's another 35 cents. Then I put on, you know, I had to roll that position that I put on previously, right? So I did a roll of the 22 April and I rolled it out. I'm sorry, the 20 April, and I rolled it out to 22 April, and cost me 15 cents to roll that, right? Same time I put on a put spread at 55 cents. Right. Then I put on another put spread, 50 cents. I bought to close the call spread, right, for 30 cents. And let's see here. Okay. Then I put on another put spread for 65 cents and was able to close the previous trades for 10 cents each. So those were, you know, closing 2 trades basically. Okay. And then you can see the numbers adding up, right? That's how it works. It's like money off, you know, taking money off a tree here. Okay. Then I bought to close the 26.25 put spread, which gave me another 50 cents. And then let's see here what happened. Okay, and then I closed the last trade here for 10 cents, and that gave me another win. And so the total for that month was $2.95 in credit. Okay, and so if you're trading, you know, if you're trading one contract and these were 5 wide, right? So you multiply, you know, one contract times 5 times $2.95. It gives you a pretty good profit for that month. Okay. All right. So that was a month where there was a lot of congestion, like what we're having now. So I'm putting on, you know, calls and puts now to get the most out of the trades, knowing that we could have a flush down, and you know, and having both sides of the trade on is great. And so this is a more recent, you know, example, and this is when in April, and the market was very bullish. Okay, and I pretty much focused on bullish trades. So let's go through this. And these are my actual trades that I did. So I was using a max of $18,000. Right, so that was $6,000 per spread. Right. But most of the time, because it was, you know, they were expiring pretty quickly and I was closing them pretty quickly, most of the time I had 12,000 on these trades. All right. So it was a total of $8,200 on that month. And these are the trades that I put on here. Okay. So the first one I put on 4/1, I closed at 4/5. It gave me $300 minus commissions. And then we move on here. I put on on 4/6, I put on a trade for 65 cents, and I closed it at 10 on 3 days later. So that gave me a total of 330, running total 630. Then I put on 4/9. I put on another trade, opened it at 60, closed it on 3 days, 4 days later at 10 cents. And this keeps going here. I put on a call spread for 50 cents. And then I had to adjust that trade. It cost me nothing to adjust it because I pushed it out from 21 April to 26 April. Okay. So I just basically moved it out there. And then on the 19th, I was able to put on a call spread, basically another call spread for 80 cents. And then bought to close that call spread for 20 cents. Okay. So that in total was $315. All right, for those series of trades there that occurred. Okay. Okay. All right, so let's keep moving on here. On the 19th, I put on another bull spread at 65 cents. And then I did close that call spread that was up here that I had rolled for 10 cents, right? Okay, I'm not leaving anything out here. And so the gain there was 330. Okay. And then on the 20th, I put on a put spread 62.5, and I know that I did it in a series of 2 trades. That's why it's 62.5. And then on the 23rd, I was able to close that trade for 10 cents. Okay. All right. And then these are the last 3 trades that I put on. So the first one on the 22nd to the 26th, 75 cents, closed it for 10. 423, I put on another trade, closed it for 11. And you can see how I'm using expirations intermittently, right? So I'm jumping from one expiration to the other, and that really does manage the risk because I don't have a big trade on one expiration. Okay. And then on the 26th, I put on another put spread, closed it for 10 cents. And again, on the 27th, 65 cents. And I closed it on 5/3 for 10 cents. Okay. So total that month, actually minus this one, because I closed this one on 5/3, close to $3,000, on that month. All right. And normally I'm making, this was a good month. I'm normally making between $2,000 and $3,000 on trading just 7 DTE. Then I'm trading monthlies and then 0 DTE as well. Right. So these are real results, guys, and it's consistent, and the win rate is about 95%. And when I say win rate, sometimes I'll get into a situation where I have to adjust, and it costs me to get that trade de-risked. Okay. And so, and I count that as a loss, right? It's a loss. And so, but it honestly, it happens around 5% of the time that I'll make a mistake on waiting too long or something, that caused it to be negative. So I'm pretty happy with that performance. All right. So technical analysis, really simple. Okay. I use Fibonacci retracement. And so you can see here from the bottom to the top, these are daily. This is a daily chart. No, actually it's an hourly chart. And I wanted to show you just the month of April because it was such a good month. Okay. It does happen quite a bit because we have, we're in a continuous bull market. And so what happened here, and then I'll show you the weeks. All right. where I was trading those trades. It was within this period of time, and you can see that it was just really, really, really bullish. But again, you have these periods here like this, but before that, this was really bullish. Okay, here was really, really bullish, and so these are times where you're managing these trades. But remember, when I put on these trades, I'm very conservative, and so I may put on a trade here for a breach that is in this area down here. Okay, and the same, and I wait for these. I wait for these drops, and sometimes I don't get them at the bottom, but it is easier to call a bottom than it is a top, so I'm pretty experienced at that. And so so I'm able to catch a lot of these bottoms, and then use the dips, to get in each time. And that's really what I do. So these dips here, okay, are basically increases in volatility, and that's when I put on those trades. Okay, so I wait for those dips to happen, and that's the time that you really want to put on these trades, just like I did yesterday. It's not rocket science, but there's knowledge here, all right, to understand. Let me see here what I put on. Okay, got that. All right, so I'm going to show you here these resistance areas, support and resistance areas, and this is just by drawing a fib. Okay, and so you can see here where the congestion is, right around these fib lines. It's a pretty accurate thing that happens. This is another fib line here, and then I go to the top here, right? So I use fib retracements, knowing when the market is here, right, and it goes down. I know pretty much where there's going to be congestion, and then I can use that to actually put on my trades. And this is an example of the S&P 500, and I use fibs on the dailies as well. But again, let me see, is it going to change? It's going to change. Okay. But again, you can see where the congestion areas are, that the market kind of stalls and then moves to the next area. Okay. And this is a pretty consistent measurement that I use. All right. So big little plug here too. We're going to have a micro futures webinar as well. You want to join that. I'm going to put the and this is my, and I just put this up today. Okay, so this is my year-to-date totals on trading micro futures. And I'm not a scalper. I'm a swing trader. So I mostly trade bull spreads, not bull spreads, bull, movement in the market. So I and I trade very, very small positions because they're micros. This is the best thing that has happened to retail traders, I am telling you, in many, many, many years. Okay, because before you had to have like a $50,000 account to trade micro futures. futures. Today, you can basically day trade futures for about $100, of margin. I wouldn't recommend that low, but I use Tradeovate, and basically the requirement, I think it's like 50 or $100 for day trading. When you go overnight, then it goes up a lot. A couple thousand, 1,000 or so. But for day trading, it's really, really great tool to use. So be sure to sign up for this one as well. And I'm telling you, this is even better than 7DTE. Okay, so I'm trading very, very small, and I make about $1,000 a month just trading futures, just putting positions out there, almost letting them run because they're so small, right? And the market's going to eventually go up, right? And so I have stop losses for like catastrophic losses, where it goes against me a lot, but still you don't lose a lot. But anyway, just a plug for the next webinar that we're doing on Thursday. Okay, be sure to join that one. All right, so I want to talk a little bit about breaking the barriers here. Okay, so the question is, would you like to follow these trades and learn how to use these high probability trades in a consistently profitable, and be consistently a profitable trader. It's one strategy, but one strategy that I've really honed in on and focused on, and that's what you need to do as a trader to be very, very successful. Okay. And so you mentioned the reason you're here. You wanna learn new strategies. I commend you for that. You always want to be learning something new, or else you get stale. You're not seeing your account grow. You haven't found the right strategy. This is a very easy strategy. It's a little complicated to understand at first, but it's easy once you get into it and you learn it. Again, it won't take you 20 years like it did for me to finally find a strategy that worked for me that allowed me to trade professionally. Okay, so you want to break the barriers? Yes. Learning, training, instruction, and practices will get you to success, but there are other factors in there as well. Okay, it's also I'm going to give you those in a second. All right, so the question is, will you keep doing what you're doing and hope that one day it's going to stick, or are you going to finally take those steps that will get you to a place that you're going to be successful, that you're going to, it's going to work for you time after time after time. And those additional things, there's discipline, commitment, having an edge or multiple edges, and a no quit attitude. That's what's going to get you to success. So the question is, are you willing to invest in yourself, to break those barriers, and you can be consistent? I'm telling you, it'll work. Okay. And I have a guarantee that it'll work. So stick around here a few minutes. All right. So our alerts, our trade notifications, and they come directly from my account. All the SPX trades, we do other trades as well, but the SPX trades, are integrated with Telegram, and the alerts are always accurate, always correct, and you can always see them because we keep them very segmented, so there's no ambiguity. All right, and these are high probability trades. All right, every single one of these. And whether you're getting started, you're already successful, you want to expand your strategies, will help you. So, and it's not a lot of money. I'm telling you, it's very, very low cost. It's designed to transform your trading from uncertain to predictable and teach you how to generate consistent returns. Right. So, and I promise you, I'm going to get to your questions. All right. So we have live chat and we have subscriber chat. So part of these are one-way communications, which are the group chats, and then we have the two-way communications which are the group chats, and then we have one-way communication for the channels. All right, and that's where we provide the trade alerts. These trade alerts come in, just like this, and this is an example of 0DTE live trades, right? Where the specific trades come in, you'll know exactly where the exits are because, again, they're coming from my account within seconds, right? I put in futures trades as well, and this is a 7DTE channel, right? So that's how we use it. And just a few success stories. Matt is Matt I worked with for many years in another industry, and was trading monthlies, and he loves the monthly trade. And the monthly trade is really just a slower trade. It's a very similar trade to the 7DTE, but it's just slower. Okay, so if you have a career and you're wanting to make income over and over again every month, monthlies are great for you. All right. Luke has been with us for a couple of years, almost since we started. He's loves the service, loves to be part of it, and basically hasn't lost any money. I think he's lost. This is what he wrote. Okay, so I'm leaving it here. I think he's lost a couple times. When we had that adjustment. And then we have ME, who loves the community and the atmosphere that we have. Remember, success breeds success. So if you're in a group that has all these successful traders, and they are all successful, it breeds success, right? Because you're gonna be in a group that's trading, and it's not only the signals that you get. we teach you how to trade. We use the indicators, Fibonacci's. We have a completely separate web page that we have training material so that you guys will learn and become independent traders. All right. So I'm not here to keep you, ball and chain in the trade alerts. A lot of people stay because it's just a great atmosphere, and the money is nothing, compared to what they're making. All right. And again, I have a guarantee. And if you subscribe for 1 month and lose money by following my trades, I'll refund your subscription by 125%. I've never, in the 2 years that I've had this guarantee, I've never had to give back money, for a subscription, because not every trade makes money. All right. But almost every trade makes money. And you're not going to walk away in 1 month having lost money, because then I'm going to have to pay you back, and that's not good. But anyway, and again, I'll refund your subscription, but I've never had to give it back. Okay. It's a real guarantee that works. This is the normal cost of our service, and it's low. All right. However, if you join today, right, and we're going to keep this open here for the next 3 hours. If you join today, your price is going to be $20 off for life. All right. I'm going to put this offer up here. So it'll share the link. You'll get instructions how to join. We do have an upsell in there for a course. Okay. And I'll go through the course in a second, but these are the prices that you'll pay, and they're already on the sales page on the website for you to join. Okay. So it's discounted already, $39, $79, and $109. And what you get is on the swing trade, you get the monthly alerts. Okay. And the subscriber chat group. On the 79 deal, you'll get the monthlies plus 0 DTE, 7 DTE. And then on the full-time trader, the 109, you'll get all those, and you'll get futures trades. And then the spec alerts, spec trades are basically premium trades that we have in there, and you get that too. Okay, we changed the name. So, and again, all of these 125% guarantee, right? Back. All right. So, in addition to that, you're going to be offered a course, okay, that gives you a ton of stuff, and it walks you through in much more detail than I did today, and examples for these trades. Okay, so the value is close to $400, and what it costs. Basically, when I started this, I was doing one-on-one mentoring, mentoring people that were doing monthlies, 7 DTE. It wasn't even 7 DTE, it was 0 DTE, and talking a lot about what's in the course. Okay, so it was $800. That was a lot. I did group coaching too with a group of people for $400. And I was doing that for a while, but I just don't have time anymore because I'm really focused on the 300 traders, or actually 400 traders that we have today now. And the course value is $397. The regular price is $149. This is what we sell it day in, day out. But during this time, if you join, you'll get the $129 discounted price, okay, for the course. And it really does go into a lot of the very important areas, especially psychology, creating a trade plan, technical analysis, all of that for $129. It's really a great value. So the question is this for you? Do you want to learn a step-by-step process to gain income in a market that goes up and down, literally? You want to finally break the series of losses and account drains, and you want to earn consistent income that sets you apart from other traders. This is it, guys. Even if you stay for 1 month, I promise you, if you follow the process, this will change your trading life forever. And it did for me. It just took me a lot longer. And so when I started the Facebook group and all this, I said, I know there's a better way for people to make money quicker, much quicker, and really, really compress the learning curve for learning this, right? And that's the program that we put together. It's a combination of learning, instruction, and actual trades for you to get going, and it gives you the confidence of training. So you get $20 off your subscription by joining the wait list. Actually, this is for waitlisters too. But if you join now, you get that 20% off. You'll be in with professional traders. Actually, people that are in there are, this is what they do. They trade for a living, and you get training and education, and filled with great content. And we're constantly putting content in there, right? And then automated signals that come directly from my account. So there's no ambiguity here. And you get the fill prices, the target prices, and the exit prices, and you get my guarantee. It's just a winning program, for you guys. So any questions? So let me take a look at the questions here, the ones that aren't answered. Let's see here. Let me go up. Okay. All right, not too many questions, so I think I'm doing pretty good. All right, doing one similar trade. You want to see if I can learn something new. Okay, great. Okay, got that. Okay, how far do you adjust? Okay, so I'll adjust the trade sometimes up to like 40 points away, depending on how early I get in or the conditions of the market. And usually do it for zero or little credit or little debit, very, very low cost, because I do it early, and I don't wait until it's breached. Current examples. Yeah, I did show you current examples, I think today in the diagrams. So hopefully that was okay. The hourly candles, some were hourly. Yeah, some were the charts that I show you were hourly and daily candles in there. Okay. Oh, 0 DTE and 7 DTE. I think somebody answered that question already. Yep. DTE means days till expiration. That's what it means. There are lessons and examples. The course will really, the course is something that's very, very different, but I have a lot of videos that I put in the learning area, in the portal, education portal, that are relevant, and you'll learn from them as well. These results look like between 45 to 60% return on capital per month. Not too shabby. Yeah. It's not quite that, but it's up there. I always say it conservatively. You can make 5 to 15% a month trading these strategies. Okay. I do better. Most people do better, but I don't want to, sell you something that is not going to happen. Okay. The capital is 8K depending on what you're trading. What I was using, it was up to 18K. Performance in July. I think we had a good July. It was definitely profitable. I can't tell you exactly what it was. I haven't looked at it, to be honest with you. Okay. Any other questions here? Futures is the 109 subscription. It's part of the plan. Okay, and then you actually get on the future subscription, you actually get 3 traders. Okay, you get me, which I'm a swing trader. I've got another trader in there that trades that basically is a scalper. Okay, and Ike, who's a very short-term trader. All right. So we have actually 3 traders for futures, and they're actually live trade rooms that we're utilizing. Okay, so it's not just signals. You're actually getting educated with Elliott Wave and ABCD patterns, and trading. Trading with live webinars, basically, almost every day. So again, we put a lot into this for you guys to learn. And to become real traders, honestly, and it'll get you there. I sometimes very, very seldom. I let a credit spread breach, and I actually did one. I think it was in July. And it was, and the reason that I held it was because the market had gone, down very, very quickly, and I had several days to expiration. And so, and I had looked at the cost of moving those trades, and it was going to cost me, but it wasn't quite catastrophic. Okay, I think I answered that question on the breach. You can upgrade or downgrade at any time. Do I have a typo in there? Oh, okay, sorry, no, okay. Code for, no, there's no code for the discount. The discount is already in place. You just have to subscribe. Okay. Okay. Yeah, we talked about the breach already. The trade plan suggests you take profit at 80%, yet your example showed 90. Oh, okay. 80% of credit received. That's what we're going for. So if I put on, let's say I put on a trade that's $1, right? So I'll get out of that trade at 20 cents, which is 80% of the credit received. You get all the trades, all the trading. Okay. Profit on 0 DTE is about 60% profit. No, 60% profit and loss. All right. So I lose 40% of the time on 0 DTE. So it's not as profitable as monthlies or 7 DTE, but they're day trades. And so I take stop losses on day trades. Okay. Okay. Yeah, futures. Futures. I've been putting on shorts actually lately on futures and profited from that. It's just a different market. All right. Any other questions? I think we captured them all. I think. Okay. So again, be sure to join. We're there. If you have any questions after this webinar here, just send me an email. I'll answer them for you. And anything else that you want to talk to me about, reach out to me, and I'll be there. Oh, platforms that we use. I use Thinkorswim. Other people use Tasty Trade. There's E-Trade, and there's international brokers. Those are the most common ones that people use. The 109 plan does include futures alerts. Hey, no problem. Anytime. Okay. It's 109. 109 for it's 109 for the futures trades. Did I say 129? It's 109. 109 discounted price. Thanks, Jordan. God bless you too. The trade room comes with the 109 subscription, the highest subscription. Okay, just to be sure, it doesn't come with the 79 or the 39. Yep, should be 109 out there. All right. All right, guys. Think I covered it. If you think of something else, let me know. You'll get the replay and the slides tomorrow. And you can always reach out to me if you have any questions. All right. Thanks and have a great day. And if you want to join the one at 8 o'clock again, you want to hear it all over again, join. You can join. Same link.